Behavioral finance and fintech, and this time the lecture would be about anchoring bias. Okay, and then we'll move down to overconfidence. So anchoring, well, it's all about your probability assessment. In expected utility theory, you work with the probability mass, right? How precise are you in estimating those probabilities? Aren't you biased? And sometimes those valuation numbers like cash flow or whatever could be biased as well for whatever reason that is unrelated to the economic fundamentals of the companies. So the anchoring bias is this one. Somehow you are anchored upon some exogenously given thing that is completely unrelated to the valuation. Um, and this makes your valuation much more conservative and not changing anything, right? You tend to underreact to news because you're anchored to a certain unrelated things, right? You get hung up onto something, right? That's the precise description, I guess. People make estimates by starting from an initial value, anchor, that is adjusted to yield the final answer. The anchor may be suggested by the formulation of the problem or may be irrelevant to the valuation. Okay? Bias occurs when adjustment is insufficient and too conservative. So, for example, well, history goes here, right? One thing that I like, right, is 산고즈, right? 산고즈, I don't know if whether this is a correct pronunciation in Chinese, but 삼국지, or three countries story in China, ancient China, right? 위초고, 웨이초, and then wu countries, right? And then the Wei country, the leader was called Cao Cao, right? Cao Cao. And then he was on a battle against the Han Dynasty, with the Chu, the dynasty, which is Liu Fei, Yubi, right? And then they were fighting to acquire the land called Hanzhong, right? Hanzhong, okay? Now the battle was about to begin tomorrow, right? Let's say tomorrow. And tonight, this evening you have to, eat something. And then Cao Cao happened to be eating chicken rib. Okay, chicken rib. And then at that time, they had to set up a passcode within their camp, right? Within the camp. Those of you who experienced in the army should be familiar with this passcode, 암구어 kind of things, right? Because we have to distinguish our group versus enemy groups, right? So if there is any spy coming in, and then you say, "Who are you?" "암구어," and then passcode, and then they have to say something, right? So every night they have to change it, right? Tonight, what shall we set it up as our passcode? And Cao Cao, gave the answer. Okay, chicken rib. Okay, why? Because no reason. He was eating chicken rib today, right? So he was like, chicken rib. Oh. And then, so that's a good example of just anchoring. Okay. Interesting story afterwards is that Yang Su, I don't know how to pronounce that guy's name, but one of Cao Cao's subordinates, right, was got this information that today's passcode is chicken rib. Oh, that seemed to imply he was overthinking about it, overbreeding about it within his brain. Okay. That chicken rib. You know what, chicken rib? There's not much meat to eat, but it is just you have to pay so much of an effort to eat that meat. So tomorrow's battle is gonna be fruitless, even though we will be trying so hard to capture that piece of land. So why don't I just pack myself and go back home? And then he escaped the camp and got executed, right? Because during that battle, you're not supposed to, quit and then go back home. So that was an interesting story about this, related to this chicken rib, right? My take on this story is that it's completely based on this anchoring, okay? Cao Cao, okay? Chicken rib. He was eating it. That was it. Nothing more. Don't try to overbrood within your brain, right? Only if the Yangsu guy had this understanding about anchorings, he would have survived, maybe. Anyway, so that's one thing that I want to tell you about it. Of course, any finance related story about anchoring? Yeah, just wait a minute. Anchoring and then conservative adjustments or underreaction, they are closely related. Another example is in competitive negotiations, outcome is often very close to starting point. Okay, like when you're doing some negotiations or merger talks, right? Where does that merger prices, right, get anchored? You will see where it is anchored later on, so wait for that. You believe the DCF valuation and all those painful process of estimating those synergy values and all those things were matter? Well, wake up, okay? This is a wake-up call. You're going to be surprised. Anyway, another one is about the earnings forecast, right? Earnings forecast or EPS forecast. In Wall Street journals, right, earnings table, quarterly earnings are compared to results from the same period last year, right? QOQ, quarter over quarter comparison is always made. And it helps to control for seasonal businesses, right? There is always a seasonality in your business. For example, iPhones or iPad. By the way, my daughters are, keep on bothering me to buy iPad. But typically people buy iPad in when? When do they buy it? Fourth quarter during their Thanksgiving holidays, right? Obvious reasons. It's a holiday and you get bonus, and then there's Black Friday kind of things. So those sales pop up in the fourth quarter, every fourth quarter. So you have you need to understand those seasonality as a base case, right? As a base case. And so it helps to control for seasonal businesses, but isn't comparison to prior quarter results useful too? Well, if you go for Google Trends and then search keywords like car, you will see those kind of seasonality popping up as a cycle every fourth quarter. Car buying, all those purchases happen to concentrate on those fourth quarter. Third quarter is rather really a what is that? Trough season or bottom season. Nobody buys it. Anyway, so the analyst, when they are estimating the quarterly earnings of the companies they are estimating, they use this kind of, there's kind of a seasonal random walk. Random walk, which model for quarterly earnings like this. So expected value of earnings on this quarter. The best guess of earnings this quarter would be last year's this quarter earnings. Okay, quarter over quarter. This kind of things happen. So if earnings follow a seasonal random walk, then best forecast would be a same period last year. Now, in practice, earnings don't follow a seasonal random walk, according to Abarbanel Bernard, right? Earnings are somewhat predictable, okay, relative to fourth quarter ago. If earnings are high, then expected next 3 quarters to be high, and then fourth quarter to be low, relatively. It seems, right, what the researchers find, when they look at thousands and thousands of analysts to report about quarterly earnings forecast, right? The researchers find that these analysts seem to be anchored upon last year's same quarter number too much, okay? Beyond the degree of seasonal random walk, okay? Seasonal random walk. And then they seem to get anchored, okay? Analysts seem to get anchored upon last year's same quarter numbers too much, so that the story, okay, the hypothetical or conceptual diagram I show you over here, okay? So let's say this is, let's say, a company that you are interested in, okay? Maybe LG Chemical or some companies, right? So that previously, the year starts, let's say you're capturing this year from 2016 and 2017 and 18, and then quarter over quarter, you see those quarterly EPS going on, and you see some seasonalities going on there, right? Fourth quarter, and then the first quarter, second quarter, and things like that. EPS follows seasonal random walk. But what I'm talking about, okay, the anchoring that I'm talking about is a bit different from this seasonal random walk, right? Seasonal random walk tells that every fourth quarter the earnings will be the blue bar like that, okay, on average. Every first quarter the earnings will be like orange bar like that, okay. But anchoring is going a step further, Okay, by the way, so EPS follow a seasonal random walk. Expected value of EPS of coming quarter would be the last year's same quarter EPS. And then the purple range kind of things is, let's say conceptually, this is one standard deviation of EPS, right? That means, let's assume the company has a long history, okay, and so many quarters the data you have it, so you have expected value of EPS as well as standard deviation of EPS. So that one standard deviation up and down is shown with purple bar over there, okay. So if you're standing over here, questioning mark over here, then what should happen? Well, the best guess for the fourth quarter earnings would be last year's fourth quarter like this with a standard deviation like that, okay. So that's that. That's seasonal random walk. But analysts being anchored, what do you mean? Well, this is it. If analysts are anchored on last year's same quarter EPS too much, their EPS estimate would be very close to last year's same quarter EPS, like the dashed boxes. So let's say instead of standing at the fourth quarter over here, okay, not here, but let's say you're standing over here, okay. Let's say you're standing over here, okay. Then what will happen? Well, right, and then you are standing over here again, right? And then the thing is, let's say your company's fourth quarter earnings was surprisingly big. There was a surprising positive earnings surprise. 깜짝 실적 보고 in Korean words, right? Positive, which is red epsilon magnitude over here. Okay, there was an earnings surprise like this, as much as the red box. Then what should happen to EPS estimates of the subsequent quarters? First quarter, second quarter, third quarter, and fourth quarter subsequently. Given that your company had a huge positive earnings surprise. Okay? The thing is, this earnings having the fact that the company had a huge positive earnings surprise, well, there must have been some economic reason why this company had a huge positive shock. Maybe there was a huge technological innovation realized and get commercialized and successful, so much so that the future cash flow will be better. Okay? That may be reason why. And then maybe the company tapped into a new market, which was promising maybe. If that is the case, then what should happen in the next quarter and next quarter, the following quarters like that? Well, that positive shock in your cash flow would not just die away within one quarter. That positive shock in cash flow may sustain somewhat more, so that it will have some sustained effect in the first quarter, second quarter, third quarter like that. And in fourth quarter to a certain degree, right? There will be some subsiding effect of this surviving positive cash flow shock, right? That could be something you would think about as a rational human being. But, as it turns out, if we run this kind of back test of thousands of analyst expectations, what researchers find is that these analysts get surprised too much in the first quarter, second quarter, third quarter, and third quarter, like this, right? they seem to be, okay, these guys, right? Those analysts, right? Those analysts are still anchored on last year's first quarter, like this amount, right? And then when it goes to second quarter, they're anchored on second quarter's result, and the third quarter still anchored. So much so that when the company announced the actual earnings results, the analyst gets surprised. Whoa, again, whoa, again, and whoa, again, right? So the analysts are slow to realize and incorporate the cash flow shock that happened in fourth quarter. So much so that they are still surprised in the first quarter, second quarter, third quarter. Okay? That's the evidence of anchoring, they say. All right? That's the evidence of anchoring. Not just that, but even more funny is that, well, when you go to fourth quarter, those analysts, now this time they are anchored on fourth quarter results in 2017, so much so that they were expecting this high, whereas those economic positive shock has now almost completely died away, so that the actual result, earnings announcement, may be like something like this, so much so that the analyst will get negatively surprised. Ooh, so disappointing compared to last quarter's big, EPS like that. So positive surprise 3 quarters and then negative surprise in the fourth quarter. That seemed to be what's going on, okay? After when they look at those thousands of earnings announcement and then earnings expectation. And those results are shown over here in the table. Autocorrelation in seasonal random walk forecast errors and those tables subsequent quarters, right? That tells us that those equity analysts, right, in the investment banks, they are anchored too much to the company's previous year same quarter numbers blindly. So they are slow to adjust to new information. Now, investors anchor their earnings expectations on the fourth quarter ago value. Then they will be positively surprised, blah, blah, blah. Yeah, this is, summarizing what I already told you about it, okay? Underreaction, overreaction happens. This is the same story as well. So the anchoring is non-trivial issue even for the financial experts, okay? Experts. Let me take you back over here. So anchoring is the one. The next one is something different that causes some trouble to your probability estimation or cash flow estimation or your investment life as a whole. Okay? Let me ask you this question. How many of you are familiar with the name Genghis Khan, right? Genghis Khan. Genghis Khan. Yeah, if you remember this song, you are for sure you're Ajay like me, right? That's a dance group of Germany that you see Genghis Khan over here. Genghis Khan. You can Google search them, right? Good dancers, by the way. And Genghis Khan is the emperor of Mongolian Empire. And then you know that Mongolian Empire is historically the largest empire in the whole world in terms of land mass, right? Now, my question is, right? Mongolia invaded all around the world virtually, right? But we are Koreans, right? So, do you remember, right? In what year did Kubilai Khan of Mongol, Kubilai, by the way, was the last son of Genghis Khan, is that right? So he invaded South Korea, not the South Korea, there was just only one Korea there, right? They invaded Korea in what was the first year that they invaded Korean peninsula. Okay, of course they occupied this peninsula for more than like what 50 years or something, and then eventually you had a huge influence of Yuan dynasty, right? But anyway, so what was the first year, okay, that this guy invaded Korean peninsula with a general called Salita or something, okay? The answering this question, please give me your 95% confidence interval of the year. Oh, that must be from year number what to what, okay? I want you to give me a range of this year. That must fall into the first year this guy invaded Korea, fall into this range at 95% confidence interval. Whenever I ask these questions, people give me different or various confidence intervals, right? So what was your answer? Okay, write down that, okay, and then see what happens. The correct answer is 1231 AD. Okay, easy number 1231 AD. Right? The thing is, some people throw out those confidence interval in a very narrow manner. For example, time horizon wise, some people may say, well, it must be 1, 2, 3, 0 to 1, 2, 3, 2. Only 2 years different, right? So that it falls into this. Some people, in contrast, they say, yeah, different color. Well, it must be sometime like 1,000 all the way down to 1300. Okay, like 300 years band. And some people say, well, that must be something like, I don't know, something like I would say 1240 to 1260. Only 20 years range. Okay, 100 years range, 2 years range, right? You see various ranges like that. And that has to do, the width of this confidence span has to do with your confidence. People say overconfidence, right? The more confident you are about this history, you will give tighter ranges. The less confident you are, you will be wide, okay? So that's the idea of overconfidence, right? People set their subjective confidence interval too tightly, and they are surprised too often, okay? So that is the story here, right? So if you gave tighter intervals like 1240 to 1241, you will be surprised. Oh, that's not 1240, but it's 1231. Well, you'll be surprised. But if you set up your confidence interval to be like I don't know, like 1200 to 1300, like 100 years interval, then you would not be surprised that much. Okay, those of you who are more overconfident get surprised more. Okay, that's one thing to tell you. Yeah, some professionals are reasonably calibrated. And Bob Schiller, the Nobel Prize winner, says this. In interviews with investors, I find that overconfidence is apparent when I interview investors. They seem to express overly strong opinions and the summary judgments. Okay? Just like in Korean song called 난 알아요. Like, I know it. Right? How do you know that? You know it. Are you sure? 난 알아요. I'm sure. I know it. Really? Overconfidence is mostly about standard deviation like this. Confidence interval, the precision. How precisely do you know about it? Okay? 난 알아요. Well, what does it have to do with the stock investment? Well, if you are overconfident about the valuation of value of a certain company that you want to invest, right? Then what would you do? I know the true value of this company. So this company is undervalued. Buy it. Click it, click it, click it. Or I know the true value of this company. It is vastly overvalued right now. So sell it. Click it, click it, click it. Sell, sell, sell. So the more confident you are, the more likely to buy and sell, trade. Okay? The less confident you are, the less likely to trade. That is critically important for brokerage houses because they make money by your trading, your clicks of buys and sells, right? So overconfident investors lose money by trading, whereas less confident investors or rational investors, they don't lose money that much, right? Because they are very careful, right? Yeah, that's one concept, important concept of overconfidence. The precision, the confidence band. How narrow is it? Okay. Another side of overconfidence is about the optimism versus as opposed to pessimism, or optimism, pessimism. For example, any of you have watched the movie or animation Frozen, right? Or 겨울왕국, right? If you have not watched it, go ahead and watch it and get some life, okay? Animation always helps you. Now, there comes one interesting character called what? Olaf, right? Olaf. That is like an icon of optimism. Optimism. Well, at one point, his friends, and they are talking about the summer, even though this Olaf has never experienced the summer. And then, what would happen in the summer, Olaf? What do you imagine yourself? And then Olaf says, it will be, great time for me in summer. And then, he's like, imagining all kinds of great things about summers, even though, he's just an ice or snowman, right? What can he do? But he's just positive about it. That's overconfidence. Another face of overconfidence, right? The future, right? For example, Corona-19 virus, right? Am I getting too realistic over here? Well, maybe. What's the chance that we are going to have a working vaccine against COVID-19? So much so that next year we're going to have a lot of fun outside Korea. Okay? Optimistic versus pessimistic. Next year, no problem, man. We're gonna go overseas and then blah blah blah, and then do our trips and here and there, like even going to the South Pole or whatever, North Pole, and then say hi to the polar bears and then penguins and things like that. That's optimism and that's overconfidence, right? And then pessimist will say what? Not likely, not likely. No vaccine throughout our lives, no chance. And, we're gonna live with this. The COVID-19 virus will be here forever, like human beings together. That's pessimistic, right? So that's confidence, overconfidence. One phase of overconfidence, being optimistic. Okay. So whenever people talk about overconfidence, you need to ask back, right? Ask back. Which side of overconfidence are you talking about? Do you realize what the hell you are talking about? Overconfidence has two phases, two dimension or two sides. One is about the precision, the confidence band. Okay, whether it is upward confidence or lower confidence, or it doesn't matter, but the confidence band. How surely are you claiming it, right? That's one part of overconfidence. The other part is about being optimistic as opposed to pessimistic about the future, right? So you need to ask every professor, every bosses, every colleagues. You have to be courageous. The problem is how to encourage the courage, right? You have to have your confidence and then challenge them, right? Oh, overconfidence, good. Which one do you mean, right? And then if they are smart, they will welcome that question. Yes, I mean Confidence is bad. Yes, I mean optimism. Okay, if they don't know, and then they will be intimidating you. Don't worry, right? That just shows their intelligence. Anyway, yeah. So that's that overconfidence, right? Um, and then Bob Schiller's right. He's over here, Nobel Prize winner in behavioral finance. And then overconfidence, where people often ask this question. Please raise your hand, right? If you believe you are a better than average driver of your car, right? Then, in my class, right, many people raise their hands, especially guys, not girls, or male, not female, right? Um, Even male, I ask them again, right? Among male, raise your hand if you believe you are better driver, better male drivers than average male drivers. And they, more than half of them, always raise their hand. And remember, to make that average, somebody has to be below average. But there's nobody, trying to be below average, believing that he is below average, right? Even among those groups, right? They may have gender bias themselves. Well, I'm male are better drivers than female, maybe. But if I narrow down to that male group, somebody has to be uh, lower than average. But nobody wants to, accept that, right? Besides, female are better drivers sometimes, indeed. We don't know which one is better drivers, by the way. And then this is a source of constant fight between me and my wife, by the way. I believe I am a better driver than average persons in the world. And my wife does not agree. And she always says, Andy, you suck in driving. Whereas I'm like, 오빠 차 핸들 살살 돌려볼까? It's like a safe driver. I'm like a safe driver, like as if I'm driving Rolls Royce to you. I'm treating you like a, how is it, queen, right? I'm serving you like a royal family. But she doesn't buy that, right? You're driving so dull. I'm falling asleep. Um, and then my daughters get pissed off at me. Daddy, why didn't you, pass that car over there? You drive, you know. And then my daughters say my wife is a better driver than I am. Fine. But my wife, right? She believes she is below average driver. Whereas I believe I am better than average driver, which is already conflicting. And then she says to me, I'm even worse than her. That's very depressing. Okay, that's very depressing. But the overconfidence, right? This is kind of a psychological mechanism that prevents everybody from killing themselves, right? Killing themselves. Suicide prevention mechanism. Okay, 자살 방지 기제. This is. Let's say everybody, if I am rational, perfectly rational, that I know myself too much, in a perfect manner, that I am a below average driver. Oh, so depressing. And then chances are I will get more depression than not. Okay, mental depression. So much so that, commit some suicide kind of things, right? Later. I don't want to do that, right? That kind of overconfidence, right? This one is circuited into our brain through our evolution process over millions of years. Think about the gloomy winter day. For example, Minnesota, right? Their winter starts from October, and then it goes until April of the following year. So which is like 6 months, where half of the year is winter. Now the rest of the year is split into 3, right? Anyway, so during that long and dismal winter, you need to have some optimism. Otherwise, you will kill yourself, right? Somebody has to believe that there will be better days. There will be better days. This, tough day will go. 이 또한 가리라, 지나가리라. It's like this tough time will also go pass by, and then good days will come. That optimism, okay, um, keeps you alive. Okay, keeps you alive, right? Otherwise, if you are perfectly rational, so much so that there seems to be not much of a chance outside, you will kill yourself. So those people who are more optimistic had a better chance of survival. Another thing is this: in the hunter-gatherer situation, right? 사냥, right? You have to go to the field to feed your family, your wife and kids, right? They cry like, "We are hungry, Daddy! Go out and then kill some rabbits and then bring it, the meat for us, right?" And there, one daddy, right, and the other, there may be a one guy and the other guys, right? One kind of guys would say what? Okay, my chance of getting rabbit with my ex will be better than average. Okay, I'm better than average hunter. Believe me, I'm gonna go there and then kill some rabbit and bring it to you. Versus the other kind of guys would say, my chance of getting rabbit is like just like the average or worse than average. And I don't want to go out, right? Then which one do you think is more sexy, right? Which one should have had better chance of leaving their kids, okay, survive, right? Natural selection happened that way. So guys are more overconfident than girls. That's, the psychology literature has proven that. This is set up like that, okay? It's already there. It's just the evolution process, overconfidence. So that's one thing that we have to keep in mind, okay? This is something important and has a lot of implication to our trading behavior, right? Overconfidence. This is implication for finance is that overconfidence can potentially explain why people trade so much, so often. Rational people trade far less often. If you are, in fact, if everybody is rational, okay, perfectly rational, then there will be no trade. Why? People will, let's say you come to me to sell the stock of, let's say, Sonoma Coffee, okay? Then what should I say to you? There must be some reason why you are trying to sell it to me, right? Otherwise, why would you try to sell it? Okay, if it is such a good company, you must be holding it. The fact that you are trying to sell it to me must be that there must be some bad news that I don't know about it. So I'm not going to buy it from you. Okay? This kind of adverse selection doubt will prevent people from buy and sell. Yeah, makes sense. Perfectly makes sense, right? So the Chicago Stokey, right? The professor called Stokey, Stokey Lucas. Anyway, they had this kind of paper called the no trade theorem paper. People are trading because they are not perfectly rational, right? Half of them would realize their information is below average, right? Daniel Hirschleifer and Subramaniam, Journal of Finance, 2001 paper, they find that the overconfidence of the investors is an important factor in their tradings. And then people get more overconfident as they trade more and then make profit more. It's a kind of an experience-based one. So experience-based overconfidence, right? Trade more, once you trade it, make profit, you get confident and trade more. Once you make loss, you get out of the picture and then just quit stock trading and that kind of things. And then talking about overconfidence, especially the corporate managers, right? Malmendier and Tate, those two guys are big shots in finance, right? Malmendier, that you see on your left-hand side, she is a professor at UC Berkeley, and she's a lawyer as well as Harvard finance PhD, if I remember correctly. So lawyer plus finance PhD, like genius. And then The other person over here is Jeffrey Tate. He used to teach in UCLA. Now he's in University of North Carolina, Chapel Hill. Big guy in behavioral finance. And then they studied the overconfidence of the CEOs. We are going to spend a lot more time about overconfidence of the CEOs. We want some overconfident guys to be the leader. You don't want perfectly rational guy to be our leaders. Why? Because it's first of all, overconfident CEOs doesn't require that much of a stock options. Okay, with smaller degree of payment compensation, the guy will try to take risk. He's courageous to go ahead because his assessment or her assessment of danger is smaller. Okay, so which is good for us, right? As shareholders, right? That's the idea. There's a good part and bad part about overconfidence, by the way, as a leader, because extreme overconfidence may make the company may drive the company into more danger because CEO's perception of risk is smaller than actual risk, and then the rest of the group, the employees, may fall into the danger. So that's it's a double-edged sword, right? But you need some reasonable degree of overconfidence to be a leader. Of course, you need this kind of overconfidence in every part of your lives, by the way, to be a good mate for, or how do you say, in your marriage, right? Good husband, good wife, regardless of your gender. People want some more overconfidence than not, right? So that's that. And then when it comes to investors' overconfidence, average investors' overconfidence, here is another UC Berkeley professor called, his name is Terry Odeen, right? The interesting thing about him is that he used to be a taxi driver, and then you can see that by that, you can see his personality of socializing, very sociable personality, right? Talking to anybody, right? By that, I think he was able to talk to the CEO of a discount brokerage house called Charles Schwab, and then the CEO opened up his data about his company's data about the individual investor trading. Of course, those identification information was kept secret and they wiped off everything, but the privacy data, right? But to the extent that the person's gender and age and the address that they live, right, like a zip code kind of things, and then those kind of what time, okay, did the guy buy and sell certain stock at what price, right? This kind of things, those big data was given to him so that he was able to study with this big data even before 2000, right? And then he specifically got interested in gender difference in overconfidence and trading, and he found out that over here, let's see. Before trading cost, average investors beat the market by 0.6 percentage point every year. But after fees, their performance trails market index by minus 1.8%. So you're losing money by actively investing. Don't be an active investor, right? Camis, right? Individual investors, or whether you call it Robin Hood investors or not, right? On average, we're going to lose money, okay? It's not confined to Korean situation. Terry Odeen showed it with US data. Ubiquitous, everybody lose money together. 1.8% per year, which means like after 50 years of trading it, you are left with nothing. Fine. Most active, most overconfident traders trail market by minus 5% due to fees, right? Nan 알아요. By clicking is like you're giving money to the brokers and lose money. Don't trade. The thing is, Over here, overconfidence. It is psychological self-defense mechanism developed over evolution process. I told you before. Yeah, and then it's hard to come up with proxies for overconfidence, but there is a lot of evidence that men are more overconfident than women in psychology literature. Barber and Odin analyzed the trading behavior of men and women, significantly different. And men trade more. Men 77% annually, and women 54% annually. Even though they after opening an account, right, in the brokerage houses. Okay, men are trading more often, more frequently. Men lose more money, minus 2.65 percentage point annually. Women also lose money, but to a less of a degree, minus 1.72 percentage point annually. Okay, so here's an interesting contrast, of course, shown in my family as well. Me and my wife, which one will be trading? You guessed right, me, right? Which one is trading more frequently and then giving money to the brokerage houses? Yeah, me. And that's why my wife said, "No, why did you do that? No, Andy, don't do it," right? So she's very careful and very rational, right? Don't she's not even interested in stock market at all. Whereas I am like, oh, don't we need to, go ahead and do it, right? Yeah, so that's one thing. So guys, before clicking your buy button or sell button, ask your wives, right, whether she agrees or not, right? That's one thing we have to, Two brains are better than one brain, by the way, and the female brain are less overconfident, so you'll be more careful, so you can take advantage, right, by combining your forces together, right? Yeah. Overconfidence, right? One of the two worst enemies in your personal investing, like Hitler, right? They say Hitler, according to Mr. Kang Hwang-guk, right? The famous YouTuber. The other enemy of your stock investment, like Stalin, was what? Disposition effect, right? We're gonna go there soon. Don't worry about it. Now, Mind Over Money video will be shown. You know, I lead you to watch it yourself, please. Right? 15 minutes of worth of doing it. I give you that time interval over there. So go ahead and watch it. Okay. The next slide here, right? Evidence outside the lab, right? In that video that you watch, right? There comes an interesting concept, right? By the way, okay? Interesting concept that, who is it? The Professor Taylor tells, the present bias, it says, he says, right? He says this, present bias, let me write it down over here. Over here, over here, yeah. At the last final minute, I changed the color. Yes, okay, final minute. Present bias is shown. Present bias. What does that mean? Well, present bias is this. You have a timeline. This is today, T0, okay? And then that's tomorrow. T is just 1. And then let's say you have 1 year from now, 365 days from now, and then one more day, which is 366 day. Let's say some people ask you, if I ask you, well, over here, right? You're standing over here. What if, okay? Which one would you choose? I give you $100 1 year from now versus if you wait one more days, I give you $102, right? Additional $2. $100 or 102, okay? Just have to wait one more day. Which one would you choose, okay? Then you say what? Usually you will go for one more days. Yeah, 1 year or 1 year plus 1 day. What's the difference? I'll wait one more day and then get $2 more. Remember this Yeah, the interest rate is 0%, right? Plus, even if the interest rate is high, you'll ignore that 1 day difference and then wait one more day. Go for it, baby. Yeah, okay. Then I ask you this question. $100. What would you choose? Or which one would you choose? I give you $100 today, or tomorrow I give you $102. Which one would you choose? And then you go for today. I want it right now. Okay? Right now. That Psy's song. Go ahead and find out Psy's famous 2010 song. Psy called Right Now. I want it right now. Okay? Why are we being inconsistent? Okay? Why am I being impatient to choose today, right now? Whereas if it was to happen 1 year from now, I would be patient enough. Okay? That patience disappears. Very tempting, right? It's now or never kind of situation. People fall into this temptation right away, right now, if it is given to you. Okay? People tend to discount too much about the short-run future. So if you try to draw some kind of a present value graph, right? Present value graph, we call it hyperbolic discounting. Okay. Before talking about hyperbolic discounting, conventional discounting using what? The compounding present value, right? It works like a exponential function, exponential decay like this, right? But the exponential decay is like every day is like proportionally decreasing, right? Proportionally, same degree of proportion, you get discounted every day. Same percentage going discounted, right? But hyperbolic discount says what? Hyperbolic discount says that your discounting happens very fast over the next 1 day or 2 days, and then over the longer term, it does not happen that much. So much so that 1 year from now, 1 day doesn't make so much difference. But your right now 1 day difference is huge. So that I want it right now instead of tomorrow. Okay? That's called hyperbolic discounting. Hyperbolic discounting. Explains a lot about people's impatience and then going crazy. Right now, you see the music video, then you will see people going crazy. So much interesting music video. I like it better than Gangnam Style, by the way. So go ahead and watch it. Evidence outside the lab. Well, if you look at the Mind Over Money video, right, at the 15th minute, that Chicago economist, right, John Cochrane. By the way, John Cochrane turns out to be, he's good looking, right? Handsome guy, yeah. But the thing is, he is, by the way, the son-in-law of Eugene Fama, right? And then they're all in Chicago, the same school. And then they say what? Well, the behavioralists argue this and that, but how much is that behavioral guy's argument applicable to the real world? Okay? The conventional Chicago-style neoclassical economics, we are talking about real-world economics and talking about those experts in the financial market, whereas behavioral guys, they're talking about the results in laboratory setting, right? How much is it applicable to the real world is a different question, they say. Okay, fine. Is that really the case? And then here comes a counterexample. It says Duggal, Engelberg, and Parsons and Wessep. They look at the syndicated loan market. What is syndicated loan? 채권단 system. There is a 채권단 means like a group of bankers, right? Group of different banks collect their money together, pool their money together, and then lend it to one company. Okay, that's a syndicated loan. So when I was working for Bank of America, we were working as a lead manager of syndicated loans to LG Philips Display. Now it is LG Display, and then some other banks like Kungmin Bank and Shinhan Bank and other smaller foreign banks. They joined us as participant banks, right? That's syndicated loan, right? $1 billion or something, right? Huge amount of money, but the banks are sharing those risks together. Okay, we were doing it to Samsung Electronics, POSCO, and then you name those big corporations in Korea. Anyway, the thing is, when you are lending this money to us corporations, you have to price that loan. Pricing that loan, what do you mean? Charge interest rate to this syndicated loan. Make sense? The interest rate, what should be that? Okay, how should we determine it, right? And the way we price it is that, well, this time it should be LIBOR plus certain spread. For example, 120 basis points, BPs, right? That is 110 to 20 BP means like 1.2 percentage points, right? So each time you set up syndicated loans, right? Start a new loan contract, right? You'll have to set up that prices. The LIBOR, what is that? London Interbank Offer Rate. We learned about it in international finance before, right? Basically, this is about the survey rate among those banks in the British Bankers Association. Every day they get together, 20 of them or more get together and then do the survey. The question is this: well, think about yourself, your bank, yourself, me, Andy Kim Bank, you ask me, and then question is, what is the borrowing rate that your bank will deserve tonight? Overnight rate. Oh, thanks for asking that. Yeah, me, I'm a top bank, so it has to be like X percent, they say it. And then they submit those answers and then take the average after, of course, trimming off those extreme values up and down. Now, by the way, the LIBOR was there was a scandal, right? Ever since 2008, and as it happened, that LIBOR scandal. What was that? Well, those bankers during the financial crisis lied in those surveys. Of course, I don't want to, admit myself being screwed in the financial market. I want to look better, right? So reporting better numbers, submitting better numbers than my reality. Not just me, but collusively. Trouble. So the LIBOR scandal, resulted in a huge fines, and then now the regulators are repealing it and then trying to replace it with other systems, right? By the way, one sidekick is that the guy who first initially found out this strange LIBOR scam, right? That was the one of the PhD in economics guy, my colleague at Minnesota, University of Minnesota. Okay, he was also in the job market at that year, I guess, a Brazilian guy. I forgot his name, but yeah, that was one interesting event that research papers. Anyway, so here is what spreads look like before and during the financial crisis. What am I trying to say here? Let's say your company, one company, okay, your one company is there. Let's say Samsung Electronics, okay. The Samsung Electronics, sometimes they borrow using the syndicated loans, maybe every 3 years, maybe every 5 years, right? It can be any period, right? But the thing is, when the bankers charge those interest rate to Samsung Electronics, okay, how many basis points would they charge? It has to depend on the current market pricing of this company, right? The credit rating of the company. Ideally, you will have to look at the Bloomberg terminal and see the credit rating of Samsung Electronics. Oh, this is AAA company. Then we should give them almost zero, like 50 or 30 basis points of loan pricing above LIBOR rate, right? That should be dependent on current credit rating of the company. But the thing is, as these guys looked at the historical loan pricing data, okay, they found out a very strange pattern, which means the loan pricing was not adjusted to the current credit rating that much, but it was anchored upon previous loan pricing. 3 years ago, credit rating was different. Still, the basis points did not change that much. That is a key finding over here. Those bankers, hey, Mr. Economist, you said those bankers are not biased or anchored or anything, but we find they are still anchored. Maybe they are looking at the previous year's accounting statements. They are glued to these accounting statements, maybe. Okay? So that's one thing they find out. The graph over here shows the average loan spread. On your vertical axis, you see a log scale, okay? So that it is 10 times difference instead of unit, standard unit, right? So you have to watch out. And then you see 2005 all the way down to 2008. You see 7 to 8, there is a slight increase. Visually, it seems like a slight increase, but it is not. It is a huge jump, given that the scale is log. You see that, right? And you see those credit rating, the spreads by credit rating, starting from the single A all the way down to triple C, which is like bankrupt companies. Anyway, the different ratings get different loan spreads. Yeah, the researchers adjust for this change in credit rating, but even after adjusting for controlling for credit rating, those remaining part of spread, basis points, stays similar. Is anchored. Now think about a firm that borrowed once before the crisis and once again during the crisis and kept its credit rating constant. Calculate the percentage change in spreads and plot the empirical. Here's what spreads looked like before and during the financial crisis. Like this. This is not the whole picture, but like this. Percentage change in spread. Those guys that doesn't change. Okay? Was so much like middle finger over here. Anchored. Right? That's the evidence, they say. Very interesting anchoring phenomena going on in loan pricing market. All right? Those guys, the researchers, look like this. Yeah. Some people show up again and again. Okay? Behavioral finance guys. Yeah, very interesting guys over there. And then Baker, Pan, and Vergler's paper is also interesting. You are taking over a target company. Okay, let's say you're taking over a certain target company. How much would you pay as a merger premium? Okay, how much would be your bidding price? Bid price for your target company. Okay, M&A valuation in our corporate finance class. We learned about DCF, and then the strategy class talked about what? Synergies and all these kind of synergies will build into your DCF in the form of cash flow, right? Your free cash flow will be rich if you have more synergies, because maybe synergy will show up in profit margin, better profit margin, EBIT, and then operating cash flow will be better. That's one idea, okay? So accordingly, your bid price may reflect all these kind of synergies and the true value of the target and blah, blah, blah. But is there any chance that this bid price is anchored on a certain number that you never expected before? Pan, Baker, and Vergler finds that it is indeed the case. Those bid price is anchored seriously to the 52-week high price of the target company. 52-week high? Yeah. So they are, taking all the acquisitions in the United States between 1984 to 2007 and they plot the distribution of offer prices around the 52 weeks of the target firm. So relative to 52 weeks target, okay, the bid price, how much above or below this 52 weeks high price. This is it, okay. Yeah, here's Malcolm Baker. Yeah, he said, this is my I call it my middle finger picture in addition to the Justin Bieber picture of Andy Kim. I'm going to show you Justin Bieber picture in my, my paper. We happened to present the papers together in American Finance Association. It was my honor, by the way. And then he liked my paper as well. It was kind of fun. And then he was discussing another one in that same session. And then he showed this picture, middle finger picture. Saying it 52 weeks high. Okay, fine. You see that absolute majority, okay, a lot of, not the absolute majority, but a lot of it, okay, is anchored on 52 weeks high price. Okay, where is that synergy thing then? Where is the DCF? Oh my god. So depressing. Yeah, I know. Overall, we estimate that the anchoring on the 52-week high leads to an arbitrary value transfer of 100 and almost $80 billion in the 5135 completed mergers and acquisitions in our sample, they say. And then, or if 18% of the total offer premium paid is wasted because it was not precisely estimating the synergies, economic synergies or fundamentals correctly, but they were anchored on this. Okay, the shareholders' response to this merger announcement, whose offer price is anchored on 52 weeks high, is bad. The investors look at it, okay, look at the merger announcement, and they say, oh, if that offer price is exactly 52 weeks high, the guys have not estimated it correctly. So, boo, that's what's going on. So even the experts are not free from anchoring bias. Now, what do you think, Mr. Cochrane? Is the question, right? So Baker and Vergler, they look like this. Yeah, we're gonna see these guys coming up in the investor sentiment later. So wait for that. Anchoring in M&A, yeah, the real case in 2017 is Broadcom plus Qualcomm. Yeah, the Korean people are familiar with this name Qualcomm because the Samsung Electronics cell phone Galaxy uses Qualcomm's chip, right? The telecommunications chip. Broadcom is also another competitor over there, and then in 2017 they announced that we are going to take over Qualcomm, right? So here's the bid price. Well, they did not precisely announce it, but there was an analyst and the journalist report that says it was around $70 to $80 per share, must have been there, like that. But that $70 per share, where does that come from? 52 weeks high. Again, all right, where's that synergy? I don't know, man. So there was a, I'm not saying that this was precisely anchored on that $70, and I'm not saying that they were pinpointing 70, but it's close to that 52 weeks high anyway. And then the journalists take it as, granted. Maybe it's an industry convention, right? They look at this 52 weeks high. But anyway, that's not value adding to the acquire a company. So what did Qualcomm say? They said no. Okay, raise the bid price. 72 weeks high. No, you're gonna pay me more, right? So they raised the bid to $82 per share immediately. Yeah. So 튕기는 맛에 at some point you have to be, wise enough to, yeah. Good. That was a good move. By the way, afterwards, Donald Trump said no to the deal. Okay? No. Why? Because it's China, he said. Right? China. Why? It's related to 5G. Okay. Donald, how much do you know about 5G? I don't know too much, but this is related to China. We have to block it. Okay. As it turns out, that CEO of Broadcom is a Singaporean, Malaysian, no, Singaporean company, but the CEO is Malaysian CEO, and then he's overseas Chinese, and then there was a concern about whether this company is related to China, especially Huawei, right? At some point, right? So America first, kind of, this policy hit this merger deals and blocked it. Interesting. Um, Anyway, so that's that. Key takeaways: M&A bidding price, synergies and intrinsic value. Where are you? Good, but typically they are anchored at what? 52 weeks high price. Okay. The most important factor in doing global business, well, international politics. Those Donald Trump, China factor, right? No matter how much you work hard, right? These kind of things at the top can block you. Okay, so this is why you have to always keep your eyes wide open to international affairs going on, right? Yeah, this is what the guys in the jail industries, Beijing, the vice president, told us, the GBA guys specifically. Political risk is the biggest one that you have to pay attention. He said it, right? Now you see what's going on between US and China, and then Korea is stuck in the middle, right? Yeah, and that's where you can contribute by studying more about the international politics, right? Yeah, people say money drives politics, but politics can override the logic of money or economics sometimes. Yeah, it happens. Anyway, right. So, next time we're going to talk about the other components in behavioral finance, unusual preferences, like prospect theory and mental accounting, all these kind of things. We're going to talk about it. So wait for that. Thank you.